Welcome everyone to today's Carbon Connect webinar on ESG reporting and transition. Our discussion today comes at a critical time. The landscape of ESG reporting is undergoing a significant transformation. For those new to the topic, Jennifer will share a quick link to a top-line guide that we made on the key implications and key frameworks. But what we're really seeing out there in the market is a fundamental challenge, which is about how can you stay abreast all the different changes in the ESG reporting space, while at the same time staying credible on your climate strategy and climate impact. That's what we're here to discuss. And that is also why we at CEEZER obviously built the tooling and offer support to keep you all compliant and audit ready. But let's kick it off with a quick overview of what's happening right now. So on the compliance side of things in the EU, we just saw the Corporate Sustainability Reporting Directive, CSRD, coming into force with its first reporting period finishing. And the last year, first reports have been coming out, which is obviously not only affecting EU companies, but also the US side of things, or non-EU companies with significant operations in the EU. And as those reports were trickling in, the European Commission proposed new legislation to change and simplify the reporting, the so-called omnibus package, which can have a significant impact on how CSRD is being rolled out, but also on some other sustainability directives, such as the Corporate Sustainability Due Diligence Directive and the EU Taxonomy, and also the Carbon Border Adjustment Mechanism, CBAM. So CSRD is a great example where globally companies need to suddenly prepare for really disclosure that hadn't been seen before, but we also see it's challenging as this is already being pulled back to some extent, or there is a discussion around it. In addition to this, there's the European Green Claims Directive, so a directive that is reshaping a bit how companies can actually talk about climate impact to customers, something that many enterprises haven't done so far, and that comes with additional challenges and how you back up your story and back up your claims with both reporting data, but also amazing storytelling. On the US side of things, obviously last year we saw the climate disclosure rules from the SEC being adopted, so that required a standardization of the climate risk data that enterprises share listed in the US. We now see that this is being revisited by the chair, so a very similar image as we can see it in the EU. Push last year, over the past years, now a potential pushback or a potential revisiting of this. On state level, there remains the California VCMDA, so the Voluntary Carbon Market Disclosures Acts, that also leads to additional exposure in some regions or for those companies that are actually active in California. So not an easy environment. And while there is probably less rules in the US around the general claims and how you tell it, we do still see litigation happening. Most recently, Apple was sued for promoting carbon neutral watches. A lot of their carbon neutral claim was also based on carbon credits. So very interested to hear a bit how companies and enterprises can successfully tell that story and tell and communicate their climate impact. Last but not least, we also have the voluntary side of things. Most notably, last week, the SBTI, the Science Based Target Initiative, published an updated draft of their net zero standard. That is the most adopted net zero standard for enterprises worldwide, allowing for a bit more use of negative emissions or carbon removal to make those targets in scope 1, and also a bit more flexible approaches to scope 3. Jennifer can also share a link to an overview to those changes. So what we're seeing is that also other market initiatives are coming along, trying to get more integrity in the market, especially on the voluntary side. So we have the VCMI, so the Voluntary Carbon Markets Initiative, defining how enterprises can make claims apart from what we've seen in the regulatory space. This is also being overhauled. It's also still a draft. So as we can see, lots to unpack, lots of context to discover in times where literally last week we would probably still have a different discussion. So it's really a time where a lot of things change. So how does it all fit together? How can you integrate upcoming disclosure and the raw and, let's say, strict data that you will disclose on climate risk with also communicating your impact and making your strategy credible? That's what we're here to discuss. Very excited for our panelists. First of all, welcome to Carolin Matuschke of EY. Carolin spent the last 5 years or more in corporate ESG reporting. She's working in the ESG reporting advisory and assurance practice of EY and advises clients from the largest German enterprises to mid-sized companies and GRI, GHG protocol, but also obviously CSRD. Welcome, Carolin. Second up, Shameek Bose. Shameek is SVP partner and global lead for responsible business and global impact at FleishmanHillard. Shameek focuses on integrating sustainability and responsibility into the heart of business strategies. He helps clients to navigate the complexities of the green economy transition while also ensuring equity and sustainability. His background includes also time serving in the board effectiveness and sustainability strategy practice at Accenture, where he worked on also ESG integration into sustainable organizational transformations. Welcome, Shameek. Super exciting to have you. And ultimately, Carla Woydt, Dr. Carla Woydt is Chief Impact Officer here at CEEZER. She has a background in comparative psychology and also worked at CDP, one of the largest also voluntary disclosure frameworks that we have for climate impact. Carla and her team created an in-depth and science-backed risk framework for the carbon credit markets that allows our clients to look beyond the certification and also helps to navigate all the intricacies that come from disclosure. Welcome, all of you. Excited to have it. We have 53 minutes on the dot, and we want to have some time for questions. So I'm going to start right off with the maybe more regulatory side of things with Carolin. Carolin, we're seeing a shift from, let's say, a mix of voluntary and regulatory frameworks, and that is slowly but surely shifting a bit to the, let's say, regulatory or mandatory side of things, right? We had CSRD in Europe and some others. At the same time, we see some rollback, or at least the risk of a rollback, right at the point in time when this becomes effective. How do you see your clients navigating this transition? And how can you prepare for something like the EU omnibus legislation?
Thank you, Magnus, and I'm happy to be here. Yes, indeed. So we can see that a lot of companies shifted now from GRI reporting, voluntary reporting towards CSRD, though we still have to see what the result's going to be with the whole omnibus situation and stop the clock. Yeah, when it comes to carbon credits, we could also see that there were a little bit like two sides. So companies on the one hand that were very proactive in using carbon credits in their corporate carbon strategies. Some companies, you have mentioned them earlier, Magnus, like Apple, that uses them for certain products. Some companies use them for their whole decarbonization strategy. And on the other hand, we also had companies there that we saw they were still a little bit reluctant because there was a lot of insecurity in the market. Yeah, so what we can see right now is that obviously also SBTi is a quite important standard that companies are looking into setting up transition plans, framing smart targets, like tangible targets, so that they have a good decarbonization story, and then also starting to look more into the topic of carbon credits.
Absolutely. And how do you think, I mean, from your auditing experience, right? So you've obviously supported first enterprises actually going through CSRD and hopefully bringing them to a successful disclosure now. Very practically speaking, like from your experience, what are the requirements of documentation that come with carbon credits? What is often overlooked? What do you go through? Like what do you value basically in seeing and verifying that the carbon credit use is responsible, but also kind of makes sense for the reporting purpose?
Yeah. So what we look at is on the one side, we see, for instance, which carbon credits or like how many emissions a company has left over, how many carbon credits do they want to buy. So is the total sum of carbon credits equivalent to the amount of emissions that they want to offset? Or let's say, depending on the claim that they want to make. Second, we look at the certificate, the quality. So we look if it's mostly like a good quality certificate, something like Gold Standard or Vera, we obviously like to see. We really ask for the specific certificate. So with a respective number, with the name of the company, with the year for which they want to use the credit. And we also ask the emails between the provider and the client to check originality of the documents so that we can actually go on the link and look into a registry of Vera or of Gold Standard, and we can really see that this carbon credit has actually been retired. Another aspect is also that sometimes it's a bit difficult to get the carbon credits on time. So we can see companies that buy at the end of the year. We can see companies that buy throughout the whole year. It is in that sense important that, like as my role when I'm partially, as you already said, auditing, but I'm also consulting. But if I'm in the role of an auditor, let's say we really want to make sure that at the end, until we audit, we have enough carbon credits retired. So I think definitely the timely aspect is something that is a bit challenging, but also, that we really require. Yeah. Maybe we can also talk about what we have seen in the last years. There was like quite some scandals going on when it comes to carbon credits. So it's like in our audits, we are not really looking, or we are not questioning the project itself, but we can only make certain checks, like is it from a good certifier? So currently what is still a bit debatable is really the effect of carbon credits. I think this is also maybe something for you. What we can see is it's a carbon credit from a good certifier, and we can check the projects, we can look at the portfolio. So we also like to see that it's a bit distributed, that different categories and different strategies were followed. Yeah, but I would say these were the most important points.
Super interesting, and I think definitely we'll have some time later talking a bit about what you don't have to audit, but yet you have to think about, right? Which is the actual impact of each project,
exactly.
how this can be verified. But I think also very valid and interesting point to understand that for the reporting and auditing purposes, this is maybe not even the focus at this point. Maybe at some point. But the other thing that I think might be interesting to think about is how do you look at basically you work with really large organizations, right? So often what we see is that enterprises are, having different carbon credit investment schemes and different climate strategies per region. There's different ways to allocate these. Some have it very central and they try to have one portfolio. Some try to just roll up what's happening in the org. What are the approaches that you have seen? What have you observed as effective, maybe also from your more consulting work when you work with enterprises to set up climate investment strategies?
I think what we can see different things, but I think what's probably most best practice, I would say, is if you have a company there that has a global decarbonization or carbon credit strategy and has is steering all the organization and operations from there. But however, that at local level, so at each site in the world, you still have a certain responsibility so that each site is also having their separate targets, their carbon credits, expenses. And I think only with a unified global strategy, but also an involvement at the local side, where sites actually have to, in the end, pay for the carbon credits, is most efficient. It's quite difficult, but at some point you have to give some steering. If all the different sites were doing their own thing, you would have a lot of, maybe even chaos. Everyone would ask their own supplier. And when it also comes to control mechanisms, I think it makes sense to have one coherent strategy and then execute it at the local level. And like this also, I think local sites are incentivized to decarbonize, because if they have to spend less on carbon credits, then maybe they also have more ambition to implement reduction measures or compensation measures.
And just to mention, right, I think this is exactly what we also see, I think, with our customer base. So that's exactly the tool that also CEEZER offers, right? It is the ability to actually set that strategy, to have technological tooling also in place to empower each subsidiary, each side to take independent decisions under a joint framework, right? I think that's something that definitely helps, but also great to hear that helps in audit later when that point in time comes to play. Super interesting. Maybe last question. We haven't really talked about scope 3 now, maybe just to understand, is that something that's currently already part of what you're auditing? I think it's a topic that we've seen being relevant for many of our clients, at least, right? It's like, how do we deal with the supply side of things? All of our suppliers, we might have a scope 3 target. How does that play into the current let's say, both mandatory reporting, but also kind of climate action landscape from your end?
Yeah, so the larger companies, so we have a lot of DAX 40 clients. Those ones, for instance, they usually have a Scope 3 carbon accounting currently set up. So we also look at that, advise that, and also audit it. When it comes to medium-sized companies or smaller companies, they are a little bit at the beginning of a story there. Some of them start to implement tools, which is quite nice and makes life for all the sites, I think, easier. So they start to collect data on Scope 1 and 2 emissions. Scope 3 is still a little bit hesitant, but some companies already started on it also from the smaller side, but it's definitely the most difficult part. You also have a lot of data insecurity when it comes to Scope 3. You need a lot of work, a lot of assumptions are involved there. And when you look at Scope 1 and 2, a company usually has those information available because these concern your own combustion and your secondary energy sources. Yeah.
Super interesting. Great. I think I'm going to pause here with the regulatory side of things. So thanks a lot for giving a bit of insight and to shed some light on what's actually happening in an audit if a carbon credit portfolio is actually looked at from a more mandatory side of things. I think what I took away is definitely the ability to be able to prove what you did, have original retirement certificates, ideally having them attributed also to the site, to each and every place of use. We're going to have a little debate about what good quality means. I think for audit purposes, it means having a certificate from a renowned registry. I think we can go a bit deeper later. But I want to shift focus a bit now on another topic, which is now that you need to communicate via reporting, right there, and you disclose more information, there's definitely a bigger need to also tell the story with it and make sure that you communicate your climate impact successfully. Shameek, so you've worked with a lot of leading companies in the world on actually setting up the strategy of how to communicate, how to disclose beyond regulation. And you say you've observed that some companies are kind of maybe entering a bit of a wait and see mode, right? Amid all this regulatory uncertainty. So to kick it off from your perspective, how can organizations balance this caution with the need to very practically maintain momentum on climate action, particularly when expectations are continuing to evolve very rapidly right now?
Hi, Magnus. Thank you so much for the question, and so great to be here with you all. I'm going to take a step back for a second, and I'm going to rewind the clock a couple of months to Davos, which you and I both attended. And I had the fortunate pleasure of meeting with a lot of CEOs, chief sustainability officers, closed door sessions. And I would say the mood in Davos was very about cautious optimism. And one number that really stood out to me is $4 trillion, which is the investment that is going to be required in order to move globally towards climate neutrality, and facilitate the green energy transition. So I have, coming out of Davos, seen a very different landscape evolving. One that is filled with uncertainty, that is filled with disruption. And as a result, corporations are in this wait and see mode. And so I have 3 kind of tips for corporate leaders that they should think about when they're trying to balance this like very diametrically opposed forces of caution yet wanting to continue momentum. So the first is really around being able to create incremental goals. So which is setting short-term goals that are achievable, climate actions that really align with long-term vision of the organization. This allows organizations to help keep up the momentum while navigating the uncertainty that they may be facing today. So it gives them that agility. The second piece of counsel I would give is to really focus on stakeholder engagement. So these stakeholders include investors, customers, employees, to better understand what are their expectations, right? So you can guide climate strategies that are both proactive, but just as importantly, reflective of your broader community standards. And the third piece of advice that I would give is really around scenario planning. So this is around developing multiple scenarios based on potential regulatory changes. You just went through a whole bunch of them that can help your organization calibrate for different outcomes, right? So while you're progressing towards sustainable initiatives very confidently, all three of these strategies will allow you to create a plan A, B, C, D, optimizing for different clients. And this is something that we do at FleishmanHillard and at Omnicom to help clients really think through, there are 4 different ways this year can unfold. How do you position success in each of those strategies, right? And that's what I think that this partnership of working with inside-in viewpoints, whether it's EY or Fleischman or others, or CEEZER, really gives the value add for companies, because we're able to benchmark, we're able to see what the market is doing, we're able to see what is translating internationally, but then has local implementation, right? And I think that's what clients really need to be mindful of, is not just carbon credits and how am I going to audit it, but how does this broaden up to your business transformation strategy, your investment strategy, and then how do you convince leaders? Because I suspect there's a lot of people on this call that are deep in the climate space, but then how do you influence leaders that are outside of the climate space that this is not top of mind? And the way you do that is you articulate an ROI, you articulate resilience, you articulate agility for your companies.
Super practical 3 steps, which we all love, right? That's amazing to hear, and definitely can share the soft and cautious optimism out of Davos. Maybe out of if you can share, right? You work with a lot of companies on exactly that topic. What are, apart from the 3, like the broader strategies that you just outlined, how can companies become a first mover, and how can you really make sure that you're tapping into any kind of advantage being a first mover at a time where I think many companies are maybe holding back, maybe stepping down, or is there even a actual advantage right now to move more quickly than some others?
Yeah, I'm gonna disclose and say I'll give you what I personally think about it, and then I'll tell you what officially I would advise clients. I have a very strong personal take on this, which is, this space has been for a very long time, because it's solving for a global commons. It is solving for something that we all face. It de-incentivizes first mover advantage, right? And because there is no benefit normally to invest more in innovation, in green energy transition, to be lower carbon, to lower your emissions, because that's going to raise prices on your products. That's going to raise, more scrutiny on your supply chain. And so as a result, the transition has been slow from a business perspective. And so that's why we have government intervention to help accelerate that, to create tax incentives and subsidies and investment to help accelerate towards the collective goal of the global commons. And so I just want to begin with that premise, because the first mover advantage has been very reticent for companies. However, the companies that are able to make strategic long-term investments, getting out of that quarterly reporting cycle, companies that are focused on climate innovation, companies that are focusing on their brand differentiation as a result of innovation and strategies and differentiating among their competitive set. And you mentioned the Apple Watch. Listen, however it landed, Tim Cook is very visionary. He thinks not on a quarterly basis, but on a 20, 30-year trajectory, right? And so even if it may not work today, can it work in the future? And then what is the incremental value to society, right? That's how leaders have to think. But to give you very practical advice of what companies should do, I'm going to double click on that word agility, which basically is adapting very quickly to changes in the market and regulatory environment. They have to focus on innovation, as I mentioned. So this is embracing technology, embracing AI and innovative solutions to reduce emissions and enhance sustainability practices. I think there is a $9 trillion investment that is already committed to AI or globally. And so we need to start thinking about how to leverage that to advance these goals that we're talking about here. And the third piece, which kind of gets lost a lot in a very competitive environment, is that we need to have a collaborative mindset to solve global problems. So that means partnering with organizations like NGOs, government institutions, and sharing knowledges and resources. That's the only way that we're going to be able to collectively solve a global problem.
Yeah, I think I couldn't agree more. And I think it also, and the collaboration, I think we've seen this, especially in the climate space, much more, I think, than in many other industries, although it is, you could argue, still also a competitive space in a way. I think what comes to mind for me is also the fact that a lot of the solutions, to my mind, are also kind of out there, meaning that a lot of enterprises also have a lot of opportunity to go out and find partners to do things with that they might not be super comfortable with themselves yet. There's best practices, as you said, you can benchmark, right? There's a lot of great tools out there that already help you to make sure that you're totally on par with what's happening. The other thing that you mentioned a bit.
Add one quick thing. Sorry to interrupt you. Is there's another very important piece that I forgot to mention that is especially critical around leaders, which is to have a very clear vision and very clear commitment and follow through. Because even the most well-meaning leaders, if they don't have a defined vision that they're prioritizing sustainability, and you see now, there is a lot of companies that are abandoning things or going silent. And I think, you have to think about the long-term consequences of your decisions, right? You have to build that support from your allies, from your stakeholders, from your employee base. And so, people have a long memory and a far reach, right? And so if you get caught up on political headwinds, I think it comes at a sacrifice for long-term gain.
Couldn't agree more. And so you said, kind of getting out of the quarterly reporting cycle, having a strong vision, but then you also need to communicate it. And we know that sustainability and also carbon credits can get very technical. From your experience, how can companies transform this, more technical information into like good storytelling? How can leaders get employees behind it, suppliers, customers behind their climate vision and climate strategy?
Yeah, Magnus, that's a really great question because we're coming out of this era of making really bold commitments and then a lot of backlash against that, whether it's, the reckoning of ESG, the dismantling of, companies that were greenwashing and a lot of visibility from an investment standpoint around scorecards that invest in sustainability strategies. And if you look behind the curtain, there's a lot of things that needed to be corrective. So before you go out and make bold commitments, you should consider three things. One is the viability of your commitment. So that means assess the feasibility and resources that is actually required to meet those proposed targets, right? That is the number one thing that I see corporate leaders really struggling with, is that they haven't done the back of the envelope calculations or work with someone like us to figure out, hey, this is the actual investment needed, but then after that, what is the internal change management strategy you're deploying in order to get the key buy-in across the entire organizations? These are multinational organizations with so many different headquarters, and you're talking about global commitments. You need to have buy-in at the regional level, at the local level, in the innovation department, in the strategy department, and they all have to collaborate together. So even if it's coming out of the head office, if you don't have that buy-in, I've seen these commitments really fall apart over and over again. The second is really, in order to actually get to that commitment, you need stakeholder input. So that means you go around, you gather insights from your stakeholders and ensure that there's actual alignment with their values and their expectations. Notice I didn't say your values and your expectations. There's a clear delineation there in terms of what actually gets buy-in. And the third is you want to assess, especially in today's climate, reputation risk, right? You want to weigh the potential backlash of those commitments and the potential backlash of those commitments not being met, which is also very important. And this is the type of stakeholder analysis we do for our clients. And one way that we've been doing this in a very innovative way is actually using AI to test sentiment with synthetic audiences, right? And so what that enables you to do is to model what the reactions will be for a multinational company. In Davos, I was actually talking to a global healthcare company, and they have a very, very difficult problem. They just can't abandon a lot of their commitments on ESG and sustainability because they're European headquarters and they will be taken into account by their local stakeholders. In the US, it's a very difficult environment on both of those topics. In China, it's a growth market, and companies that are more sustainable and ESG oriented, as you know, China has made a lot of investments in this space, from solar to wind and other energy. It's actually growing, right? And so they're in a very difficult landscape from a communications perspective because they have to balance a strategy that is nuanced enough, that is flexible enough to be deployed in a local market, but aligns to their global goals.
Super interesting. And I think, I don't know, maybe Asia, I think generally super interesting place. I think we've seen a lot of traction coming up. China introduced the largest compliance carbon trading scheme by coverage, not by trade yet, but at least by coverage, right? And I think we also see some reporting things coming up. Carolin, I'm not sure, I don't want to put you on the spot. I'm not sure how deep you are in the global reporting landscape, but I think also some news we can definitely follow up with that that we see out of Asia. So I think, especially for global companies, right, that's a challenge. And thank you, Shameek, for those insights on communication. I think it's super helpful, super exciting to think a bit through that. So now maybe shifting focus. Now we've heard a bit what you have to do and what is currently like the mandatory, let's say, scope, which is obviously having your data in place, having the retirement certificates in your name at the right time, on time, having that fully trackable, including all the whereabouts of the transaction, something that's obviously very natural to us at CEEZER. Then, Shameek, you added that if you want to communicate about this and get your org behind it, you also need to be able to translate this into a certain ROI, but you also need to make sure that you get the buy-in, right, from not only internal, but also external stakeholders to continue to do it at a time when it's kind of shifting a bit behind. So lots of different requirements coming in. Shifting to you now, Carla, you spend the majority of your day helping large enterprises thinking about how to best invest, right? Like how to get to the best option there. So you once said, and I always like to repeat this because it's quite a good sentence, that net zero strategies can't happen without carbon credits. Like at some point you will need carbon removal, you will need some external beyond value chain mitigation measure that is then accounted into your footprint. From your perspective, but also from the data and the risk work that you're doing on the carbon markets and on climate investments, how can, to your mind, companies now effectively communicate this reality while also addressing the skepticism around the role of carbon credits? And as Carolin outlined, you can be very diligent in retiring credits and having everything in place, but you might still face a public backlash, right? So maybe expand a bit on this.
Yeah, absolutely. And thanks for having me. Thanks very much, Shameek and Carolin, for your perspectives. I think super valuable and a lot of points to touch on. I think it's for every single company that we're engaging with, it's and this is true for many different levels of a company in their climate journey. It is important to remember, so the science is very clear, right? So we need 5 to 10 gigatons of carbon removal every year by 2050. This is stressed by the IPCC from a scientific perspective. We see that many frameworks now start incorporating that, right? So SBTi is kind of reconsidering their framework and putting more emphasis on carbon removal. VCMI already worked with a good way to transition towards the targets while including corporate carbon credits into a corporate climate strategy. And also regulatory frameworks are incorporating carbon credits. So we see that everyone is incorporating that, everyone acknowledges that there is an importance, and net zero, the net in net zero means that there is a component of carbon credit or carbon market engagement, right? We also know that it is just not possible currently to reduce all of our emissions. So all of our emissions. So the question is, where is the skepticism coming from? And this is coming from bad decisions being made in the past and still being made at the moment, to be honest. And this is what we're seeing. So it is absolutely critical to have a good visibility over the market and to not only focus on price, for instance, not only buy as many credits as possible for a cheap price, to fulfill isolated claims that are not embedded in a larger climate strategy, but also, Carolin, what you just said, to go actually beyond looking at carbon standards only. This is a clear filter, and this is also the first filter that we apply looking at reputable standards. But we see that within those standards, carbon credit quality or carbon project quality is very, very different, right? It is different across different project types, but also within the same project types, carbon credit quality is absolutely, can vary a lot. And as another level, no one actually knows what carbon credit quality is, right? So there is no one definition. All of that creates the uncertainty, Shameek, that you also touched upon, and creates the skepticism. So the recommendation is to have a very, very clear strategy in place on how to engage with the voluntary carbon market, right? So it starts with having a clear vision of the portfolio goal. What do you want to do with your portfolio? Do you want to work towards your net zero target, use it for neutralizing residual emissions? Do you want to engage in beyond value chain mitigation? These are considerations that you need to do. And based on that, you would create your requirements. What are the requirements you want to see in your portfolio? What are the standards you want to work with? Yes, what is your budget? That is a very, very important aspect. What are the technologies or the project types you want to buy? And what are the regions? Should they be aligned with your countries of operation, with your wider supply chain? So having a clear visibility over the requirements. And then, and this is the step that is, from what we heard from you, Carolin, not yet implemented in the auditing, is really do a thorough due diligence on line item level. So every single project needs to be checked, needs to be assessed on very different parameters. And the parameters should cover what is the current price, what is the price development, what is the availability, but also what is the quality risk and what is the delivery risk of a project. And I'm going to touch on that later in a bit more depth. But I just want to stress again, like having this strategy in place and the good visibility actually helps you to communicate with confidence about your carbon market engagement, because it gives an objective basis on communicating why you are engaging with the market. And this transparency is very much valued by your stakeholders.
Super true. And I think maybe in the discussion we can touch a bit upon the country matching. I think would be interested to hear, Carolin, if this is something that you look at from the auditing perspective, because it is such a global market, right? And I think there's always like arguments for and against it. But before we do that, maybe just like imagine now from Carolin's perspective, right? CSRD is coming up. You're going to disclose in your carbon credit portfolio. If I take Shameek's perspective into it, the board obviously wants to communicate well. It needs to be part of the strategy. So you have that task to build a portfolio that kind of is both compliant with what you need for mandatory reporting, but you also want to make sure that everything that goes beyond it works. It's aligned with your values. It's aligned with the overall strategy. So practically speaking, how do you approach it? Like, what do you recommend buyers how to start thinking about it, how to build their portfolio? How do they balance these different requirements effectively?
Yeah. Very good question. And it starts again with the portfolio goal and can be an incremental goal, right? So be aware and know what you want to do with your carbon credit portfolio. Then, as already stressed, so the requirements can have several shapes and forms. We see there is a large overlap with the technology standards regions. But then also know your budget, and not only now, but also for the next couple of years. So because if your portfolio goal is to neutralize residual emissions at your net zero target here, you need to know, and this is also one of the discussions within the Science-Based Target Initiative currently, how to get there, right? How to ramp up supply, how to make sure that you will have the supply at your net zero year, and also to make sure that you pay the best price that you can get it for. So price is something that you should look in, but also you have to assess your own risk appetite. And very practically speaking, this means that every single carbon credit comes with a risk. That is important to know. And a portfolio can cover certain risk and can balance certain risk. That's the beauty of a portfolio. But that doesn't mean that you shouldn't look into every single project within the portfolio and assess the risk individually. And the risk can vary along. There is a risk attached to quality. Of course, we know that different project types already have inherent risks. But then different projects, like singular projects, also have individual risks that need to be assessed. I already mentioned that there is a price risk. So there is a price you pay for a credit right now, but also there is a development, an expected development of the price. And you have to assess, what would I pay for a credit from a project right now, but what is the anticipated price development in the future? Delivery risk. If you, Shameek, you said it, if innovation is the key and you decide you want to invest in more nascent technologies, you have to live with the risk that those technologies in many cases are not fully certified yet. The protocols they will be certified under might be very new as well. So there is a risk of delivery in time, which can affect, Carolin, to your point, the delivery in time for your reporting. And this is a risk that you have to factor in. And then another point is the host country risk, right, or double claiming risk. You also have to be able to monitor what is happening in the host country. Are there any carbon credit regulations? Is there any risk of double claiming because the project activity is included in the host country NDC, for instance? Based on that, you draft a purchasing roadmap. And what does that mean? It means that for every single project in your portfolio, you assess whether you want to buy it on a spot purchase or you want to engage in a long-term offtake. So you need to reserve a certain degree of flexibility to react to market developments. That's the agility that we already discussed. But also you want to hedge for anticipated supply availability and price risk. And that is part of the purchasing roadmap. And first, and then lastly, you also want to monitor your portfolio over time, right? You need to make sure that you monitor all of the development in the markets, that you monitor all of the developments in each and every single project to make sure to react in time whenever there is something coming up that affects your portfolio negatively or maybe even positively.
Right, and then I think, Shameek, you mentioned, which I also think is a super important point, is like the price risk, right? I think it's something that, if you look in the past, it hasn't been a problem for many years. Theoretically, because prices were relatively flat, there wasn't a lot of differentiation. I think over the past, we've seen sometimes 3x to 4x of increases within like 12 to 24 months. And I think, Shameek, you talked about the agility, right? At the same time, obviously, as a CFO, I want to know, what do I have to spend on my net zero commitment in 2 years, in 3 years, in 5 years? Carla, what's the current view in the market? What do you see in terms of long-term price risks?
So there is a lot happening. So a price is determined by the implementation cost, of course, but also on market factors, so anticipated demand, right? And we see that for nature-based removal is currently one of the project types that many corporates are purchasing. There is an anticipated price increase over time. So it is very recommendable to start engaging right now and to engage in a long-term offtake, because you might hedge for those price risks and there might not be enough availability in the future, because we see that many corporates are engaging in long-term offtake. So you would also hedge for the availability risk. This picture is a little different looking into certain durable removal technologies. For instance, we see that for direct air capture, there is a lot of efficiency increases being gained at the moment, which brings the price down. The same for biochar. We see there is a bit more availability in the market, so still the prices are going slightly down. But we already see that this trend is kind of is decreasing. So the decrease is less steep, because we see there is a lot of demand for biochar at the moment, and this demand is increasing. So it already interferes actually with the projected decrease of the prices. And those are the dynamics that we currently see in the market. We have a good visibility over the trend, but also what I said in terms of flexibility. So it is important to have a certain part of your portfolio just open or flexible to ad hoc innovation, let's say, sprints that come up during your portfolio lifetime. Shameek, you had a question, I think.
No, I was just going to mention that, I've worked with many corporations that think about buying carbon credits. And so for our audience, if you're part of that planning process, this point about price risk is very, very important, because there's this conception when chief sustainability officers and other key stakeholders think about offsets or their long-term strategy, that this market is ample. There's so much room there and the dynamism that you you talked about, Carla, it doesn't get bubbled up as much to the top of the food chain. And so I think that's very important I suspect a lot of people listening will be the ones that will be conveying that up the ladder. And so, and the long-term benefits that you talked about, right? So getting in earlier on, how that can also save them money down the line is another really important angle that I think doesn't get talked about as much in the broader corporate context.
Absolutely. But maybe, Carolin, asking you from a more disclosure perspective, do you think CSRD can help? Like, do you think regulatory disclosure can also help to kind of make that more top of the agenda, or to convey those important points more to the board?
Yeah, definitely. So, I mean, right now there was no real requirement on how to disclose the use of carbon credits. There are also companies that actually buy them. They make they have it for certain events or certain products, but they don't really want to make it public in the report because they're a bit hesitant and worried that it could backfire to them because it's not part of a whole bigger carbon strategy or decarbonization strategy. So actually, when I look at the CSRD, and Carla, you also said there are so many different types of credits, different qualities, not even in terms of what they are certified, but what they actually mean. They have different impacts. And the CSRD right now also obliges companies to cluster them per removal activity. So I think the CSRD will help a lot to bring more transparency into the market. We can see the first reports out there, and this will also hopefully help to improve the image of carbon credits and also eventually help our planet, right? So in the end, I think we all want to do this because there is a bigger goal. The transparency will help, but also comparing each other to other companies will help, and ultimately we can capture carbon from the atmosphere, we can remove carbon, and we can take care of our environment.
But a good way to kind of close that discussion. That's exactly what we should be going for. I want to really encourage everyone on the call, if you have questions, to post them, send them across, use the tools there. In the meantime, as more come in, maybe just like last point, I think one interesting aspect, I think that many also in that role, right, I have to get to a portfolio. I'm starting to plan this. I need to convince my CEO eventually, or at least the board, but I also need to get in procurement. We talked a bit about the pragmatism earlier, right? That also price plays a role. I don't want my products to be uncompetitive or too expensive due to my climate strategy. Maybe a quick round, Carla, from a more quality perspective, right? But also maybe Shameek from a storytelling perspective, or the board enablement perspective. What are best practices to kind of get procurement and the CSO and all the different players into one field? What have you seen works well to get there? And obviously Carolin as well, if you want to comment.
Shall I quickly start? So what we see was what works best if a company adopts a nested approach. So you have the overall strategy, like the sustainability or ESG strategy, then you have the climate strategy as one part of it, and the carbon credit strategy as part of the climate strategy. So always goes hand in hand with reduction activities. And if this is aligned, actually, there is a strong narrative inside a company already, because you have, on the one hand, you have the science-backed climate change mitigation aspect of carbon credits that can be used for your climate reporting, really data-based, data-driven, science-backed. But also, and Shameek, that's something that we touched upon actually, is carbon credits also have additional benefits beyond carbon, right? So especially high quality nature-based removal, but also other project types have an impact on biodiversity. They have community benefits such as supporting education initiatives, access to healthcare. So all of that helps to shape a strategy, and having a holistic strategy in place always helps to also get the buy-in in the company, also from the purchasing department, right? And for the purchasing department, what I see is, of course, most important is still the price and the delivery, so more the technical aspects. while the sustainability department has a more nuanced look at carbon credits. But if it both is aligned, and there are individual levels in every company, responsible sourcing teams, but also for the ones that just start in their climate journey, I think it's a very compelling story to also integrate all those different views and kind of overcome the gap. And integrating price and delivery is asset and must be like a critical element of a strategy, while not forgetting about the carbon aspects and the beyond carbon aspects.
Shameek, anything you wanted to add?
I'm happy to go next. So, Magnus, you framed this question, how we should communicate to the leadership, right? Boards and C-suite. And recently, I've been getting a lot of calls from boards and C-suite who have been trying to accomplish this. And, the question on top of CEOs' minds and board of directors' mind is, what does the customer think about this? What are my stakeholders? What does the community think about this, right? And so I'm going to give 4 strategies on how to effectively communicate this, regardless of wherever you're based. The first is really around cultural sensitivity. You really have to, in today's dynamic environment, tailor messaging that aligns with local values, local priorities, local concerns, and making each specific message relevant to each audience. The second is using a research-driven approach. So you have to now, before you send out anything, conduct a regional research to understand the perceptions of sustainability and adapt your messaging accordingly. The third is that you have to anchor to global goals, right? We can't forget about the collective. We can't forget about the broad strategy. And positioning regional strategies as part of a broader corporate commitment to sustainability, while reinforcing the global narrative and allowing for those local adoptions. So giving flexibility, even though you've set a broad global goal. And finally, create that stakeholder-specific engagement. So identify key stakeholders in each region and develop targeted strategies for two-way communications, right? So it's not just telling them what you're doing, but soliciting feedback, which is a continuous loop. And we believe at FleishmanHillard that by navigating these aspects, leaders can really inspire trust and action towards sustainability while addressing both the challenges and shifting stakeholder expectations.
Oh, very nice. So let's pick up a few more from the audience. And I think the other aspect that I just thought about, by the way, is maybe also with the business case, like, can this be part of what we do? Is there like another angle that we can have? I think that's another thing that helps these days. But maybe to you, Carla, considering the increased scrutiny around the integrity of carbon credits, especially forest-based, nature-based solutions. I think we have a question from, I assume, someone in Brazil. How can Brazilian forest carbon projects better align with evolving ESG reporting standards and international buyer expectations? So what do we see in terms of signaling quality? What can projects do to stay ahead of the curve there?
Several aspects. One is like there are a lot of like new methodologies coming up. So I mean, having one of the most recent methodologies is definitely key, because they also include newest technology for digital monitoring, reporting, verification. So digital MRV, making sure that you also leverage all of those new and innovative technologies to make sure that you can actually demonstrate the impact of your project. The other thing is definitely the impacts beyond carbon. I think especially nature-based solutions have a very good like they have a very good position there to stand out in the market, right? And I already said that biodiversity is certainly one, but also making sure that this project is embedded in the local community, that this project does good for the local community, also changes the mindset on the ground, and helping to develop in kind of like synchronous, like the environmental impact together with the social impact. And I think being able to communicate, show, and provide data about all of those aspects really help to further increase appetite for those kinds of projects.
You, Shameek.
Yes, I'm so glad we got a question about Brazil, because I want to, close with one sentiment, which is I speak to a lot of people in the climate space, sustainability space, and to be really honest, a lot of them are disappointed and are feeling hopeless. And one thing that I think is going to really help bring global collective movement is COP30. And we see a tremendous interest going to Brazil for COP. We're helping our clients prepare for it right now. We're taking them on advanced tours. And the reason why it's really important for the people listening on this call is that we need to bring our global community together. And the fact that it's going to happen in Brazil, in the Amazon, speaks to this question, right? It speaks to carbon credits, it speaks to nature, biodiversity. And I think having immersive experience is really what's going to help us, one, create change as a community, but then also allow leaders to really understand. So I encourage everyone to champion for this global gathering and bringing your colleagues there. And if you have any questions, we're happy to assist as well.
Yeah, I couldn't agree more. And I think we're all excited to go. I hope we see many there, and and definitely a great place to be. I think one other question, and looking at the time, maybe like a 2-minute answer, whoever wants to take it, maybe I think could be for each and everyone. So there's a lot of price volatility in the carbon market, and there's a increasing emergence of long-term offtake agreements. So the question is a bit, how should capital-intensive industries like the shipping industry hedge delivery and price risk while pursuing a net zero portfolio? And I think that goes beyond the shipping industry. I think we have that discussion actually with players also from the energy sector, cement, building materials, right? So you have a lot of, let's say, large scope 1 companies or large scope 1 and 2 companies that obviously have maybe also less margin in their business to invest in climate right now. Maybe, I don't know, Carolin, maybe you can share a bit. I don't know if you have some clients in that space, how you see them doing it, but I think also maybe Carla or Shameek, maybe you have some experience with that as well.
I mean, yes, we do have like clients from all different industries, but maybe the specific on price risk is something for Carla, maybe. Yeah, I mean, if companies have a lot of scope 1 and 2 emissions, it definitely makes sense to have good, reliable carbon credits in there. I don't necessarily think that they should just start on later. They can also start buying carbon credits now and invest early. And as you said, Carla, maybe also look at it in a more strategic way. It makes sense, as you said, right, to build the carbon portfolio, and then depending on which carbon credits might also be a bit more cost effective, but also effective and impactful. They can also start with those carbon credits and then from year on year and build on their carbon portfolio and divergent it. But I think in the beginning it's important that companies know their carbon accounting, have a powerful transition plan and decarbonization strategy, have a clear roadmap, and also then start using carbon credits so that when they want to go into the offset of their residual emissions, they know exactly in which carbon credits to invest on.
Yeah, maybe trying to put that into sentences, I think it's important to start now, right? So the more we channel, the more investment we channel into the durable removal industry right now, the more the prices will go down, the more this industry can scale, right? And we don't necessarily have to start with a ton for ton approach, right? You don't have to start with neutralizing all of your currently remaining emissions, right? But start small and ramp up over time as much as you can, right? Because everything is better than doing nothing, and everything helps the industry. So my recommendation would be to map out where you want to be at your net zero target here if you have, but also how much you can contribute, how much you can really spend on carbon as compared to like the carbon you are emitting, right? Because we know, especially for those companies with a high scope 1 and a relatively low profit per ton, it is hard to really engage with the market at the beginning based on a ton for ton approach. And this is something that doesn't have to be the case at the beginning when you start your carbon market engagement journey.
I unfortunately have to cut it here. We're at time. Thank you all so much. And for those questions that weren't answered, make sure to reach out to us. We're happy to connect you or to come back to you in writing. Thank you so much, Carolin, Shameek, Carla, for your amazing insights and for joining today. I think super relevant discussion, super interesting mix of perspectives. And of course, also thank you to Jennifer and team for setting it up. And thank you for each and every one dialing in. Appreciate your time and interest. And yeah, looking forward to the next one. Thank you.